Hello and welcome. You're watching KYC, and of course, we are now starting to understand and assess how GST is impacting consumption, and at the forefront of that is ACs, fans, air coolers, and the like. And Symphony therefore comes to the fore, and therefore the first question I'd want to really understand from someone like a Symphony is that how elastic is demand? Would demand go up significantly if the GST is to come down, which it will on the 22nd of September, and therefore what should we pencil in? The essential question is how much will volumes go up by given this GST rate cut that has come through. So that's going to be maybe my first couple of questions. The third question is going to be around weather patterns, and the weather has impacted volumes in Q1, but likely there's going to be a catch-up play in the second half of this year. As the monsoons recede, hopefully in September, can we start to see a strong sales growth come October as the heat before the winter kicks in, and whether we can fully catch up with the kind of sales loss we've made in Q1. That's what I'd want to understand, whether we can reverse that. A double-digit growth is what they've penciled in on a very, very strong base of FY25. Wanting to see whether there's a positive bias to that commentary coming through. In terms of the third piece, it's outlook on foreign markets and new categories. Now, you've seen a bit of a leg up that the numbers got in FY25 because of China and the Chinese subsidiary turning positive. Can that kind of trend continue? Can the losses from foreign subsidiaries or the lower profitable subsidiaries, can they start to reverse and aid the numbers overall, especially where foreign markets is concerned? And can new categories continue to drive up growth and allow Symphony the scale it needs to expand margins? And of course, we've already seen a very large margin expansion. Can that continue? Do they plan to divest from any of the markets? This has been a recurring question, given that Symphony does ever so well in India, but not so well in some of the foreign markets. So is there a plan there? And last question that I'd want to ask is, what is the margin outlook? And we spoke about that, and we'll obviously look at the numbers as well. And when we do, you'll get a better perspective as to what I'm talking about where margins is concerned. We've seen quite a bit of change where the margins is concerned, FY24 versus FY25. Now let's talk a little bit about Symphony itself, what it does, and give you that overview with regard to what it does. It's a leading branded air cooling solutions provider. It, in terms of products, I will get to it, but it exports to 60 plus countries. The core is eco-friendly, energy efficient air coolers for residential, commercial, as well as industrial. It's expanding into all weather, adjacent small appliances like fans, as well as water heaters. That's the other key category they are entering, but currently smaller in comparison to the larger pie that they are focusing on, which is air coolers. The last piece is, it's an asset-light business, has a dominant position in India, and it has a pivoting international strategy. Now, let me focus on this for just a little bit more before I go to products. If we can roll back the slide, there you go. So one asset-light business, it doesn't have a manufacturing facility. It has third-party manufacturers which manufacture for it, and it sells. It's a 6,500 crore market cap company, and it does nearly 1,500 crore plus of sales. And that kind of underlines to you that the asset-light strategy is what they use for this purpose. And therefore, can they continue to deliver on that strategy is the core question. It's dominant in India, but it's pivoting its international strategy. Are they doing that in a significant fashion? What's the impact of that going to be is what I'd also want to know. So a little bit about that. Now let me talk about products, and you'll get a decent sense of what they do therefore. Air coolers, which is the primary product. There are multiple models for different price points, and some of that, the fact that they've come in with new models has aided the numbers for FY25 as well. So, so air coolers, of course, is its core product offering. The other one is, of course, commercial cooling as well, large space cooling for factories. They also do tower fans, kitchen cooling fans. They also do water heaters, and they've launched a couple of new ones as well this year. And this is, of course, the upcoming segment that they have. So you might well see this as something of a renewed focus area and a larger mix coming through in terms of some of these new and alternate products that they're doing. Then there is spares and accessories, which is replacements for the current products that they have. So broadly, that's how Symphony shapes up, both in terms of business model, and products. Now let's talk about all of the key metrics, and we'll start off with the income statement, of course, the balance sheet, thereafter cash flow, return ratios, shareholding patterns, street cred, street coverage, and valuations. We'll cap it off with those 8 metrics. And let me not delay this further. Let me talk about the income statement right off the bat. If you see the last around 3 to 4 years approaching FY24, you saw nearly no growth there. You saw some bit of margin expansion, but no material growth. So the entire 15% CAGR that you're seeing on a 3-year basis, pretty much all of it is back-ended, which is between FY24 and FY25. But nonetheless, it's still a 15% growth. That's what you essentially look at. And what you also therefore see is whether margins are expanding, and they have. FY22 was a good margin year, after which margins fell, and now they fully recovered. They were 15% in FY24 and currently sit at a very healthy 20%. So that's the broad way in which margins have moved. Net profit also has shown decent growth. FY22 to FY23 was a tough year of sorts. Thereafter, we've seen a renewed pickup in the profitability, which has gone from 122 crores in FY22 to 213 crore in FY25, with a real bump up that we've seen in FY24, post FY24, all the way through FY25. So that's where some positive momentum has been built up. I also want to try and highlight that the Q1 FY26 numbers weren't exactly the best, and that's understandable. We've still given this a thumbs up. In fact, there was 400 crore of sales in the Q1 FY25 quarter, and the sales in Q1 FY26 was just 250 crore. So we've seen a shrink with regard to sales. Margins as a result as well have come off sharply when you're looking at the Q1 numbers in particular. So you want to keep your eye out on that one. You want to see whether there is a recovery at play. Mind you, Q1 was a quarter where for the AC market in India, it was a tough quarter because monsoons came in early, if you remember. And weather-related factors have impacted sales in Q1 FY26. But could you start to see a reversal, or is it loss of sales? That's something that I'd want to somewhere take a feeler from the management as to whether they'll expect that revival regardless of GST. And of course, the GST will probably spur it further, because that will aid both margins and profitability to come in sharply higher if that were to come through. So something you want to keep your eye out on. Now let me take it to the balance sheet. And the balance sheet is an interesting one. Generally, when we look at the book value, it goes up. Here, you're seeing the book value go down, and that's because there's a 270 odd crore buyback which they've done cumulatively over the last couple of years since FY23. So since this point, they've done around 270 crore of buyback, and therefore what you're seeing is some amount being shaved off the book value, because you start to see reserves, etc., being adjusted for that. So broadly, that's how it's played out, and which is why you're seeing it go down. But otherwise, if you look at the borrowing, it's a very small number for a 6,500 crore company, and the book value is at around 760 crore odd for a 6,000 crore market cap company. That's broadly the take. Decent amount of cash also sitting in the books. So no concerns here per se. We've given this a thumbs up as well. Now you look at cash flow. And cash flow will give you a picture with regard to cash flow from operations to EBITDA. and that is quite decent. It's 80% plus. There is some receivables where amounts are locked, but outside of that, there's no concern per se, and therefore we've given cash flow also a very healthy thumbs up. There's been no problem whatsoever. Now, the jump you saw in profitability in FY25 will reflect on the return ratios. Let's pull that one up, and that's what you'll see, that extremely sharp jump, and there you go. That's the ROC. But outside of that, if you look at the ROC numbers, it's been largely range bound. So decent kind of ROC shape that we've seen. Of course, FY25 is that year in which we've seen an anomaly, and FY26 we've seen in Q1 that pressure come through with regard to ROC as well because of pressure on margins and profitability. So likely you'll see a shrink on this. How much, whether they can maintain 20% plus will really be the question. So, but we've given this a thumbs up, of course, given the stability of it and the possibility that you could well see it shrink is something that you want to keep your eye out on. Now, let me talk about shareholding. You're looking at 73% promoter ownership here, which is more than decent. You've got FI is also owning a bit of it. DI is also owning around 9% and then you have public holding the rest. So broadly, it looks like a good structure in terms of shareholding pattern as well. No concerns here. In terms of trades and block and bulk deals, not too many insider trades either to talk about, any material ones at least. So so that's something that's not much of a concern. Now let me talk about some of the other metrics. Let's talk about street cred, and when you look at the 1 month performance, when you look at the 6 month performance, the 12-month performance, you've seen clear and constant pressure on the stock price. So that's how the stock has done in terms of performance. Clearly there's pressure, 40% down from the last year, and only a 12% return is what it's given over the last 5 years. So we've given street cred a thumbs down, given that this has been a stock which has performed preciously little over the last 5 years, and there's clearly been pressure on the counter. So that's how we've shaped up street cred. Now let's talk about valuations, and when we stack up the valuations, you're looking at Symphony at nearly 32 times. When you're looking at Voltas, Blue Star, all above 70 times. So that's something you want to think of. There's also Crompton and Whirlpool because they are diversifying into that segment, and therefore Symphony stands out in terms of valuations in comparison to all of these. So there's a thumbs up there with regard to where valuations is concerned that Symphony commands. But of course, there's a larger tilt towards AC, and that's something you want to keep your eye out on. Street coverage, 7 buy, 1 hold, 1 sell. Firstly, the coverage is just 9, so we've tried to be a little more tempered here, but a 37% is the average upside. And therefore, ideally a thumbs up, but we've just been a little more cautious here and given this a neutral, thereby arriving, and let's stack it all up, at a rating of 6.5, very healthy, on our KYC rating, with a thumbs down on street cred. But outside of that, when you look at the metrics, well, it's a very solid set of metrics that we've tracked. Very, very few companies where we've seen this kind of set of numbers, all of them come together very, very well. So 6.5 on 8 on our KYC final rating for a Symphony, and broadly, that's how we sum it up. Now let's talk a little bit also before. Okay, so we have with us Nrupesh Shah, who's the Managing Director, Corporate Affairs at Symphony, joining us. Great having you here, Mr. Shah. Good morning. This is Harsh here. Let me first start off by understanding what is your sense with regard to the elasticity of demand for the products you sell. You believe that this GST rate cut is going to really aid the numbers in a very solid fashion for you, and how much of additional growth are you already penciling in for the current year, if that is so?
Thanks for having me. First and foremost, let me clarify. As far as air coolers are concerned, there is no reduction in GST rate.
Right.
Earlier, it was 18%, and it remains intact at 18 percentage.
Right.
So, all the cooling appliances now, whether fan, air cooler, or and air conditioner, are in 18% category.
Correct.
So as far as GST is concerned, it's a neutral for Symphony and air cooler industry as a whole. That's number one. Number two, however, that doesn't change anything in terms of the outlook, in terms of the growth potential. By the way, I was just listening to your very impressive commentary, but just to add some more flavor, in last 3 years, as far as Symphony domestic sales is concerned, it has registered CAGR annual growth of 23%. That is as far as the domestic household air coolers and other products put together. Again, having said that, as June 25 summer was not quite conducive for entire cooling industry, there has been a degrowth, but still June 25 summer quarter registered second highest June quarter sales in the history of the company. What I mean by it was better than earlier best of the base season. And the reason being, one, wide variety and range of product and air cooler category. Secondly, deep penetration, what we have done in last couple of years in semi-urban and rural, and especially alternate channels, including e-commerce, D2C, apart from large format stores. And in addition to that, in financial year 25, 21 percentage of the top line and almost similar bottom line was contributed by non-household air cooler sale in domestic market. What I mean by 21 percentage sale was contributed by products like large space ventilated air cooling, that is centralized air cooling, water heater, tabletop fan, kitchen fan, and exports from India. And by the way, in June 25 quarter, that was 30 percentage. Few years before, this percentage was minuscule, and they are having huge, immense growth opportunity.
Understood. So, sir, let me clarify this. GST rates have been brought down across the board, which means which gives the people more spending power. Do you believe that that is going to drive top line growth for you in a better fashion this year, in a year in which Q1 in any case was subdued? So give us that perspective, sir. That's where I'm coming from.
Sure. So one, on account of GST rate reduction, and secondly, earlier on account of income tax rationalization. I think the overall estimate is close to 2 trillion rupees will be saved by the customers or the end or the taxpayers. And good amount out of that has to come back to the consumption. And certainly that should be a huge boost for an industry like us. Not only that, as of now, or even as on 30th June, across consumer durable, whether you name it refrigerator, washing machine, air conditioner, air cooler, there has been huge inventory pile up at a trade level. In fact, this will also help to substantially uptake the festive sale. And on account of that, it should also substantially help to us as well as other companies.
Got it. Got it. Okay. So that should certainly aid the numbers. What are you penciling in, sir, in terms of FY26? What's the top line growth looking like for you?
As per our IR policy, we are not allowed to share any forward-looking statement. But considering normally summer sets the tone for the whole accounting year, and hence obviously current quarter and next quarter is likely to be subdued. But as I explained, non-household air coolers and exports from India to an extent has a potential and likely to make up to some extent that shortfall.
Understood. Sir, with regard to export, and we speak about this even from a perspective that FY25 was a bit of a turnaround year for you where exports is concerned, or where your foreign markets is concerned, if I can call it that. Do you expect that to sustain, and this real sharp expansion in margin that we saw in FY25? Of course, Q1 has already been a very soft quarter. So give us context on where should margins therefore lie for the full year?
Yeah. So first question related to exports.
Yes, please.
Certainly, I think a lot of work has been done by the company in last couple of years, and we are witnessing the result of that. And hence, we are very optimistic about the exports from India. And hence, in line with that strategy, focus on India and exports from India, we have decided to put on block our two overseas subsidiary companies, one based in Australia and second in Mexico. It doesn't mean we are necessarily exiting from those markets, but it makes a lot of sense to produce and export from India with the local team. So that's number one. Number two, as far as exports are concerned, vis-a-vis international players, mainly Chinese players, Symphony's products are far, far superior and still really value for the money. And we really give a run for money to the Chinese players in terms of the product, in terms of the pricing, and still commanding a decent margin. And as far as the margin for the year or down the line is concerned, certainly our contribution margin or gross profit margin will remain intact as we witnessed last year. However, when it comes to the EBITDA margin or PAT, it is also the function of the economies of scale and top line, because beyond certain level, fixed overheads as well as advertisement, sales, promotions don't necessarily go up. So it's also partly a function of that. So in the medium to long term, if we register very healthy growth, there is a possibility to improve the margin.
Got it.
At EBITDA level.
Yes. Point taken. So your valuations look compelling versus peers, and therefore give us some flavor as to how investors should think of your business. Let me step back and maybe think of this from a 3-year to a 5-year perspective. I know you don't give a guidance per se, but what is the aspiration? Can you grow, given that the market can grow, and because there is such a large demand which India can cater to, can a 10 to 15% growth be something that one can pencil in on a CAGR basis over the next 3 to 5 years? Is that something that you would aspire for?
So as far as market is concerned or channel is concerned, with their aspiration or forward-looking statement, they are one and the same, other than one is a fine terminology. Nevertheless, of course, internally in the organization, we do have short-term, medium-term, as well as long-term business plan with scenario A, scenario B, as well as scenario C. And obviously, we have very ambitious aspiration in terms of the growth, performance and profitability. And as I mentioned earlier, and as you were also sharing with the viewers, as far as domestic household air coolers are concerned, in last 3 years, there has been 23% CAGR growth. And on a console basis, we have registered 15% CAGR growth. So that is the kind of the potential. And in addition to that, the kind of new models we have launched, new range which we have launched, and some other new categories which we are emphasizing, I think it seems a very bright future.
Right. Point taken, Mr. Shah. I understand where you come from. Let me also try and get a lens. You've spoken about a couple of subsidiaries being completely divested, Australia, Mexico in particular. Where does that therefore leave you where profitability and margins on a steady state basis in a regular year is concerned? What is the thought process there? Because, of course, FY26 looks like a year in which it's going to be difficult for you to clock the kind of margins that you've set for yourself in FY25. So FY26 is going to be a tough year, but at a steady state, what is the expectation?
So as far as Symphony India is concerned, I think in the medium to long term, we aspire to maintain the margin what we achieved in FY25. That's number one. As far as our console financials are concerned, I think our margin should improve. The reason being our Australian subsidiary and Mexico put together, they are dragging down the margin as well as they are also blocking, especially Australia, the capital. So in fact, we will be in a position to improve top line as well as profitability after divestment.
Perfect. Thank you so much, Mr. Shah, for coming in and speaking with us. This has indeed been fun speaking and you know, great insights all around as to what to expect overall from the segment as well as from Symphony. Thanks so much for coming in and speaking with us. But that's all the time we have, viewers, with you as well on this edition of KYC. But stay with us. More action on the other side. Thanks for staying with us. And more action on the other side. So continue to stay tuned to NDTV Profit.